Okay, so welcome back to the desk. We're going to move on now to self-awareness statistics, and specifically the statistics that are used in the industry on the professional trading side, the most popular ones in order to measure a trader's ability. And overall, these are very, very important metrics because you have to measure your own ability as a trader to understand your strengths and weaknesses, and also to make informed decisions about deploying capital overall to your portfolio. So the first one we're going to look at is the Kelly criterion. And the Kelly criterion presentation is available in the PTM video series. So we're going to look at this one first. This is a presentation that I gave 2 years ago at Cass Business School, and everything is still the same. The Kelly criterion is still used and very popular as an industry metric in order to measure a trader's ability. It can be used in stocks, it can be used in currencies, it can be used across all asset classes. Now, mentioned previously in the risk management section of the video series, we did touch upon the fact that retail traders don't have a boss or risk manager on a trading desk that measures their ability or deploys capital to them or makes up the rules in terms of capital deployment. And professional traders and hedge fund managers have this luxury where they have a boss or the head of the fund, the head of the desk, or a risk manager that actually measures their ability and decides on the deployment of capital to that trader based on their overall abilities and their performance metrics in their portfolio. Unfortunately, retail traders do not have this at all. So you are your own boss and you are trading your own money, and you have to make your own decisions on when to deploy capital and when not to deploy capital. And this is why self-awareness statistics are so important. You need a mechanism in place which basically measures on all your previous trades your abilities, so your strengths and weaknesses as a trader, so you understand when to deploy capital and when not to deploy capital, and also to work on your weaknesses. So the position you have to imagine yourself in now is that you're constantly applying the overall process to the Forex market that we've been through, so the idea generation process, gatekeeping, real positions, and managing risk in your portfolio. And now you've been through a number of trades in the past. And now you're measuring your abilities, your strengths, and your weaknesses. And this is one of the big problems with retail traders, is that they don't have a boss. You are the boss. And if you don't have a boss and you are the boss, you have to actually measure your own ability objectively and do this so you learn about yourself as a trader and know better when to deploy capital and when not to deploy capital over time or at any period in your life. So the first one we're going to look at is the Kelly criterion. Go to the download section, you'll be able to pull off the spreadsheet. So download the spreadsheet and go through the formula. Make sure you understand, you know how it works. And I'll see you at the end of the presentation for a conclusion at the end of this video.
Okay, we're going to move on to something called the Kelly criterion. So we've touched on this idea that when we're winning, we want to be seeking more risk. We've touched on the idea that when we're losing, we want to be seeking less risk. We want to be pulling from box B. So box A when winning, box B when losing. But what if we looked over all of our trades in the past? We looked at our track record, and we actually started to look at what type of trader we are. What we want to have is self-awareness, so we know what type of trader we are. One of the problems with retail traders is that they don't have a boss. So you don't have anybody to tell you whether you're any good or not. So you don't know whether to have more capital or take away capital from yourself. So what would a hedge fund manager do if he had a portfolio of 8 traders and 3 of them were making money and 5 were losing? What would the hedge fund manager do? Well, to the hedge fund manager, those guys who are losing money are just losing positions in the portfolio of traders. A hedge fund manager doesn't trade stocks, indices, currencies, commodities. A hedge fund manager who has traders working for them trades their traders as positions. Hedge fund managers trade humans, or hopefully non-humans. What does a funds of fund manager do? Trades humans that trades humans. Go and speak to a funds of fund manager and ask them what they do. In a nutshell, they'll say, I trade humans that trade humans. That's what they do. The only problem is retail traders, you guys, you don't have anybody to tell you whether you're any good or not. How much capital to deploy to you, how much capital to take away from you, when to do it, etc., etc. But what you can do is use the same processes, the same tools that a lot of hedge fund managers use to have self-awareness and basically tell you whether you're any good or not over the history of your trades. So it's just having self-awareness, and not just whether you're any good or not, but what you're good at and what you're bad at. And you work on the things that you're bad at. One thing that's going to tell you whether you're any good or not, which is pretty damn obvious, is whether you make money or not. But if you're making money, it's a mix of things, of behaviors, of what you're good at and what you're bad at, and in overall terms, whether you deserve more capital, and if you do, how much, and when you should deploy it. So we're going to look at the Kelly criterion, a bit of self-awareness. So based on your trading performance, the Kelly criterion just basically tells you how much you should be committing in capital terms to your next trade. It started in the 1950s on the horse racing track. Gamblers used to use it when they went to the horses, to the racetrack. So they go to the racetrack with $100 and they go on race 1. Well, let's put the question out there. If you go to the racetrack with $100 and there's 10 races today, how much do you put on race number 1? Okay, so you lose your $10. How much do you put on race number 2? Okay, you lose your $9. How much do you put on race number 3? Yeah, so what you're doing is you're taking capital away from yourself for each trade, yeah? In the reverse, walk onto the racetrack with $100, you put $10 on and your horse comes in and you make a total of $18. What would you do next? Yeah, you take more risk, yeah? So the Kelly criterion basically rewards traders who make money by saying you put more capital on your next trade, and takes capital away from traders who always lose. The marginal rate that you take off and put on, that's what Kelly tells you to do, yeah? But it's a great litmus test when you look back at your last, say, 50, 60 trades, what type of trader you are. So let's just have a look at an example. So we've got here a theoretical trader who's done 60 trades. On trade 1, this trader made $5,000 and it's a win. So a 1 goes in the win score. On trade number 2, this trader made a loss of 5,000. So a 1 goes in the loss score. So far, the trader's made no money. And they've got a win ratio of 50% and a loss ratio of 50%. Yeah? You keep going all the way down. And we've got the results here. So the trader on their winners has made $272,000. On their losers, the trader has lost $148,000. They've made money on 30, they've won on 30 of the trades, made money on 30, lost money on 30. So win ratio 50, loss ratio 50. Is that a good trader? So basically, the Kelly criterion says that on the next trade, this trader should put on 23% of their exposure on the next trade. %23 of their money on the next trade. Is that sensible? So over 60 trades, this trader's got 50% of them right, 50% wrong. They've made 272 on their winners, lost 148 on their losers. The ratio between money made on winners and money lost on losers, 1.84. And the Kelly criterion says 23% of your money on the next trade. So first of all, is this trader any good? Who says yes? Who thinks this trader's bad? Who thinks this trader's just average? Okay. The answer is this trader's pretty damn hot. What is W? What is W and what is R? W is the ability of the trader to generate ideas and time them well. Yeah? Is 50% any good? It's good. What is R? R is the ability of the trader to manage risk. Because they can have lots of good ideas, but if they don't run their winners and don't cut their losers, their R is going to be awful.
What is a good R?
That's a good R. Anything around 2 plus is great. Over a good sized number of trades. So if you look back over your first year and you've done 60 trades and your win rate is 50, your loss rate is 50, and your R is 1.84 plus, if it's 2, amazing, you're doing well. So you're obviously making money, you've got good ideas, you're timing them quite well, and you've got good risk management. Now what happens as a hedge fund manager if you're sitting in the back and you've got a team of 20 traders and you've got every trader's spreadsheet with their last 500 trades, and you're charting in the spreadsheet as well, you're charting that every trader's W, every trader's R, their profit and loss, and they're all on one chart, and they're moving in real time. And you see traders who were really, really good starting to become bad. And you see traders who were really, really bad starting to become good. What do? You take money from the guys who are starting to get bad and give it to the guys who are starting to do well. Now, it's not 100% scientific, but that's an example of what hedge fund managers do. So they'll actually be charting the performance of their humans. Does that make sense? Now back to this issue of 23% in your portfolio. That's a very high number to have one position making a contribution to that in your portfolio. But what does that say, for example, if you put a limit on it and say you start off with a position that's between 5 and 10% of your portfolio, and it starts to show that it's a big winner in the portfolio? What do? You add to it. Now, what happens if originally your single asset position limit was 10%? Your single stock position limit was 10%. Should you be adding to it? Should you be adding, if adding to it means you're going over your self-imposed 10% position limit, should you add to it? No, you absolutely should. Because Kelly's telling you you're allowed to. You're a good trader. In this situation, you can have comfort that you're pretty good and you know what you're doing in pretty much every situation. Because the last 60 trades says, as a trader, you know when to add to winners and you know when to cut losers. What would that mean if you were working at a bank or a hedge fund? It would mean you'd have to go and see your boss and ask for permission to do it. I really want to add to this winner. Can I break my single stock position limit? Absolutely. Go over by 5% for the moment. Now what happens if it goes in your favor more? What do? You go and ask your boss permission to add more. And you keep pulling from box A. And you keep rolling your stop loss until you get stopped out. And what will happen once or twice every year, when you start off with your single position limits of, say, 10%, and those winners start to appear, and your history as a trader says you know what to do on your winners and you know what to do on your losers, so you can take comfort in your track record that you know what you're doing. One or two of those trades per year is going to pay you 50% of all your money for the year. Because you're going to go from 10 to 15% and it'll continue. You go from 15 to 20% and you'll continue. You go from 20 to 25% and you'll continue. And you'll keep rolling your stop loss. And by the time you're done, it'll have made you a fortune. And what happens? How do you actually exit that trade? You don't. You'll just get stopped out. You just keep going. Make sense? Every target is a soft target. And what will happen in that situation? After you've been stopped out and you enter that trade into your Kelly criterion, your R score is going to go through the roof. And what have you done for the next 6-12 months? You've just given yourself license to continue trading like an animal. Because your R score's just gone through the roof. That's what you've got to do. So put every trade you do in the Kelly criterion. Start off with self-imposed position limits, but those position limits are soft. Only when winners emerge are you allowed to break limits. You never break limits on a loser. Ever. Monitor your Kelly criterion, your K score. And if you ever go for interviews, print off your track record of all the trades you've ever done and staple your K score on the front and leave it with the guy or the person that's just interviewed you. And if you've done a couple of hundred trades, you've got an R of around 2. And your K score is 23, 25%. Your W's 50. Whoever it is going to be pretty impressed. If you do that, it's worth as much as your degree on your CV. And in the process, you'll probably pay for your degree. That's what you've got to do. So you know when to deploy capital to yourself and when not to. Now, what happens if you get to the end of year 1 and you've got a good W, got a good R, and got a good K score? You want to be putting more money in your trading account. Box A. You're good at trading. So why are you limiting yourself? Shoot for the moon, and you'll fall amongst the stars. You're selling yourself short. Take more risk. Because you've got a stop-loss portfolio anyway. So it doesn't matter, you might as well take more risk. But if it goes wrong, you better trade out of the stop-loss portfolio. I've seen nightmare situations where guys have gone from £20,000 in their trading account to over £300,000 in a year. And by the end of year 2, they're at 0. Because they didn't put risk management parameters on their portfolio.
Okay, so welcome back to the desk. What we looked at there, the Kelly criterion, really is a self-awareness statistic for you as a trader to really understand when and when not to deploy capital. So more like gross exposure, and also learning about your strengths and weaknesses as a trader. Now, when you think about the data that we looked at in the Kelly criterion, we looked in the example there at the last 60 trades of a trader. So it's pretty obvious that if you're going to learn about yourself as a trader over time, you're going to have to get to a point where you've actually done quite a lot of trades before you can start to build a picture of when and when not to deploy capital and how much, and also your strengths and weaknesses as a trader. So what you actually have to do with the Kelly criterion as a self-awareness statistic is just keep updating it, put all the trades in that you put in. If you're adding to positions, it's really all just one trade, it's one position. So if you're long euro dollar and you add to that 3 times, so you've done a total of 4 trades, you want to be putting the whole lot in to the Kelly criterion as one position and one P&L, because that one position is essentially an idea and you're managing the risk all on one position. So the Kelly criterion, it's not going to tell you immediately what type of trader you are. It's going to take a while for you to build up your track record of trades before you start really getting scores that are meaningful over time. So we looked at this thing earlier in risk management, gross exposure. That's very important to the Kelly criterion in the first thing that it tells you. So what should I be deploying in terms of capital based on my own past abilities as a trader? And a good trader, you're going to be in a winning position. And in terms of your gross exposure, this is when you have to pull from box A. You have to seek more risk. If the Kelly criterion is telling you that you're a good trader, you should be seeking more risk. And you do this in two ways. Firstly, you can just increase your exposure in your portfolio because you will have got to a point where you've made money and the Kelly criterion is telling you that you're a good trader, you've got good ideas, you've got good risk management, or it's solid, and you're going on this journey of making money, and you can just simply increase your exposure. Or you can actually go and add money to your trading account, or a combination of both. So for example, we've looked at multi-asset class portfolios, where we've looked at, say, stocks, equities, and Forex exposure of a couple of $100,000, and we've looked at Forex only portfolios in risk management where we have 150,000 exposure, with, in both scenarios, having a decent amount of margin deposited on account. Now, if you say put $25,000 into your trading account and you have a $100,000 to $125,000 Forex exposure, whether that's in a Forex only account or a Forex and stocks account, so combined portfolio, it's $100,000, $125,000 exposure to Forex. And if you have that $25,000 in your account and you have the $100,000, $125,000 exposure, and specifically on Forex, you make, say, in 8 months' time, so over your first 8 months, $12,500, then essentially you've made a 10 to 12% return, roughly speaking, on the overall exposure in the portfolio. Now, this is good. It means you're winning based on Forex volatility. That's a good return over an 8 to 12 month period, and you should be really proud of yourself to get to that point. As you've been building on that journey, you've probably gone from 100 to 125,000 exposure because you've been making money, and at that point your K-score is going to be saying that you're good. You've got a good W, you've got a good R, things are under control, and you should be increasing exposure. So the K-score and your profit will be telling you that you're good. So what you should be doing here is actually increasing your exposures, or your gross exposure, and probably adding money to your trading account, because you've proven to yourself now that you're a pretty good trader. Now, what would you do in the situation if you're actually losing money? So 8 months down the line, you've got your 60 to 100 trades in the Kelly criterion, and it basically says you've got a bad W, a bad R, and your account's actually losing money. Well, your account's telling you that you're not good because of the loss that you're making, and the Kelly criterion, it's going to be reflected there. So if you're losing money, what's actually probably happened in the process with that account, let's say you've gone from 25,000 down to 20,000, is your risk parameters that you've placed on your portfolio will have actually been triggered through that process. And that's why we have them in the first place. So our stop losses are there to basically protect our downside. And the K-score will basically say that you're not good as a trader, you've got a bad W, a bad R, so you've got bad ideas and bad risk management. Or it may be a combination of good ideas that are just timed dreadfully, and your risk management is bad as well. So you have to have a look at the K-score and figure out if there's any ongoing concerns, and learn about your weaknesses, and if you're even making money, learn about your strengths and your weaknesses and where you can improve. And that's the second thing that really Kelly tells you, is that your strengths and weaknesses as a trader. So first thing, deployment of capital, how much to deploy, whether you're any good. Second thing, strengths and weaknesses. So if you're a trader who's traded over an 8-month period and you're struggling, so for example, you're losing a little bit of money, you're flat, you're making a little bit of money but not much, there's probably something in your entire process that's not working out right. Maybe you've got a good W and a bad R. Maybe you've got a bad W and a good R. So what your ideas might be good, your risk management might be bad. Your ideas might be bad, but your risk management is really amazing. You've got to figure out what your strengths and weaknesses are and work on your weaknesses, really. Because once you bring up your weaknesses, if your W gets better, you're pumping more better ideas, and then your risk management will look after itself. If your W is good already, but your risk management is bad, then you've got to figure this out and work out in the process what's going wrong. The other thing in the Kelly criterion is also when we look at single asset position limits and breaking those limits. If Kelly is telling you that you should be deploying more capital to single positions, that's all well and good, but the reason why we have single asset position limits in the first place is to stop us being human. And we can start off with starter positions, move to full positions, and if Kelly is giving us a signal that we should be actually putting more money into our single trades, that's a nice thing to know, and it's doing that because we're good traders. And we're good traders because we're managing our risk properly. And that's all come in the past, and Kelly is telling you that you've done well in the past. So you shouldn't feel bad about not deploying more capital if Kelly is telling you to do so. What you should be doing is sticking to your risk limits, and when you get paid as a big winner, or big winners come through in your portfolio, then you have license to break limit, but always with a rolling stop loss that we looked at in risk management, and the rolling stop loss is in front of your average price, so you can always protect your gains. Okay, so that comes to the end of Kelly criterion, our first self-awareness statistic. We're now going to move on to further self-awareness stats in self-awareness 2, and I'll see you in the next video.